There's a doctor who drives a leased BMW, sends her kids to private school, and eats out most weeknights. On paper, she looks like someone who has it figured out. In reality, she couldn't come up with $5,000 without selling something or going into debt. And there's a plumber 2 towns over who drives a 10-year-old truck, wears the same 3 pairs of work boots on rotation, and has never spent more than $400 on a single piece of clothing in his life. Nobody looking at his driveway would guess he has $2 million invested. Here's the part that should bother you. If you line these two people up and asked a stranger to guess who was doing better financially, almost everyone would point at the doctor. She looks successful. She looks like she made it. The plumber looks like someone who's still grinding, still hasn't arrived, still has a ways to go. The stranger would be completely wrong, and this mistake, confusing what someone owns with what someone has, is exactly why so many people spend their entire working lives accumulating the appearance of wealth while never actually building any. Before I go further, let me be clear about what I'm actually arguing, because the title of this video is intentionally a little provocative. This isn't an argument for dressing badly or letting things fall apart around you. It's an argument against spending money specifically to impress people who, as you're about to see, are barely paying attention in the first place. Those are two very different ideas, and the entire video lives in that distinction. Let's start with where this idea actually comes from, because it's not a hunch. It's one of the most well-documented findings in personal finance research. The classic study on this, which surveyed actual millionaires across the country, found something that surprised even the researchers conducting it. Most millionaires don't look like millionaires at all. Research from Ramsey Solutions found that 94% of millionaires still live in middle-class or modest neighborhoods. A more recent study from Empower found that over 62% of everyday millionaires still budget, shop deals, and avoid extravagant lifestyles even after crossing the $1 million threshold. About 60% live in homes worth less than $500,000. Even Warren Buffett, one of the wealthiest people who has ever lived, still lives in the same house he bought in 1958 for $31,500. The overwhelming majority of millionaires in this research are self-made, not the recipients of inheritance. Many spent decades in professions nobody associates with wealth at all: teaching, skilled trades, government work. The wealth wasn't the result of some singular high-income breakthrough. It was the result of a spending pattern maintained consistently over a very long period of time, regardless of what came in. This creates a genuinely strange paradox once you sit with it. The people who actually have the money behave almost nothing like the people who appear to have it. The original researchers behind this work created two useful categories to describe this: prodigious accumulators of wealth, people whose net worth is high relative to their income, and under-accumulators of wealth, people whose net worth is low relative to what they earn, regardless of how much that is. A $50,000 a year worker can be a prodigious accumulator. A $250,000 a year professional can be an under-accumulator. The income level tells you almost nothing on its own. What predicts the category is spending behavior, and specifically, how much of that spending goes toward things other people can see. Here's their formula for figuring out roughly where you should be, and it's worth running for yourself. Multiply your age by your pre-tax annual household income, then divide by 10. That number is roughly what your net worth should be if you're accumulating wealth at an expected pace. A 40-year-old earning $80,000 should have approximately $320,000. Most people, when they run this calculation honestly for the first time, are surprised by how far below the number they land. Not because they're failing at life, but because almost nobody has ever explained that this number exists, let alone why it matters. So why does looking wealthy actively work against becoming wealthy? Let's get specific, because this isn't just a vibe, it's math, repeated over and over across a lifetime. Every visible purchase carries what's sometimes called a lifestyle multiplier, the idea that a single purchase rarely stays a single purchase. A nicer car doesn't just cost the car, it often nudges you toward a nicer neighborhood to park it in, nicer clothes that seem to match it, restaurants that feel proportionate to the image. None of these follow-on purchases feel like decisions in the moment. They feel like the natural, inevitable next step once the first domino falls. This is precisely why visible spending is so much more dangerous than invisible spending. A better mattress doesn't trigger a lifestyle cascade. A better car very often does, because a car is seen by everyone, every day, including you. Let's run an actual comparison, because the gap compounds faster than most people expect. Say two people each earn $90,000 a year. The first buys a $55,000 truck on a 6-year loan, ending up with a payment around $800 a month once insurance and fuel are factored in. A completely normal, unremarkable decision by today's standards. The second buys a reliable 5-year-old sedan with cash for $14,000, keeping their monthly transportation cost, including insurance and gas, closer to $250. That's a difference of about $550 a month, or $6,600 a year, invested instead of financed. Invested consistently at a 7% average return over 20 years, that $550 a month becomes something in the neighborhood of $270,000. The visible difference between these two people on any given afternoon in a parking lot is obvious. One has a much nicer vehicle. The invisible difference, 20 years later, is $250,000, sitting in one account and completely absent from the other, and it happened without either person doing anything dramatic. It happened because one of them optimized for what strangers would see, and the other optimized for what their own future would actually contain. Let's run this same exercise on housing, because the numbers are even larger and the trap is easier to fall into, since housing feels like a genuine need rather than an obvious luxury. Say two people, again, both earning $90,000, are choosing where to live. The first buys a 4-bedroom house with a finished basement and a guest suite, priced at $420,000, because it has room to grow into, and because it's the kind of house that signals arrival. Their monthly cost, including the mortgage, taxes, insurance, and the higher utility and maintenance costs that come with more square footage, lands around $2,900. The second buys a comfortable 2-bedroom condo, sized for their actual current life, priced at $240,000, with a monthly cost closer to $1,750. That's an $1,150 monthly gap, larger even than the vehicle example. Invested at the same 7% return over the same 20 years, $1,150 a month becomes something in the range of $565,000. $500,000, separated almost entirely by square footage that, in the first case, mostly sat empty except for holidays. This is the part people find hardest to accept about housing specifically, because a bigger house doesn't feel like status spending the way a luxury car does. It feels responsible, even prudent. But the math doesn't care how a purchase feels. It only cares what the purchase costs, every single month, for as long as it's owned. The same pattern shows up in smaller categories too. Clothing, in particular, tends to carry a brand markup that has nothing to do with quality and everything to do with what the label signals. But transportation and housing are where the real money lives, because they're recurring, not one time. Here's the part almost nobody talks about, and it's actually more interesting than the math itself. Everything we've covered so far explains what happens when someone chooses visible spending over invisible spending. But the real reason this mistake is so common and so hard to see from the inside is psychological, not mathematical. Visible spending is, in a very real sense, spending on other people's opinions of you. Nobody frames it that way to themselves. It gets framed as, I earned this, or I deserve this, or This is just what people at my level drive. But strip away the framing, and what's actually happening is a transaction. Money changes hands, and in exchange, you receive a certain image in the eyes of people who, statistically, are thinking about you far less than you assume they are. Research on this consistently finds that people wildly overestimate how much attention others pay to their purchases. Nobody remembers your car nearly as vividly as you imagine they do. Meanwhile, the money spent to achieve that fleeting impression is gone permanently, along with everything it could have become. Compare that to invisible spending, the kind nobody sees, the kind that shows up only on a statement you check privately. An index fund doesn't impress anyone at a dinner party. A high-yield savings account doesn't turn heads in a parking lot. A paid-off car with 140,000 miles on it doesn't generate a single compliment. And that is precisely the appeal. Invisible spending, because it carries no audience, never triggers the lifestyle multiplier. Nobody's version of keeping up involves matching the size of a stranger's index fund because nobody can see it. The absence of an audience is what allows this kind of spending to simply compound, undisturbed, for decades. Now, it's worth pausing here to address the honest exception to all of this, because pretending visible spending never matters would be its own kind of dishonesty. There are specific situations where appearance genuinely functions as a tool rather than a vanity expense. Someone in outside sales meeting high net worth clients may find that a certain level of visible polish actually affects their income directly. Someone building a personal brand or running a business that depends on perceived credibility may find that appearance is, in a narrow sense, a business expense rather than a personal indulgence. The honest test is whether you could point to a specific, measurable return on the purchase. More clients, more income, more opportunity, the way you would for any other business expense. If you can't, it's probably not actually functioning as a tool. It's functioning as a cost. Let's talk about what this actually looks like day to day, because it means being deliberate about which categories of spending you're willing to make visible and which ones you're willing to let go invisible instead. Transportation is usually the single highest leverage category to reconsider, because it's simultaneously one of the most visible purchases most people make and one of the largest recurring costs. The typical millionaire, according to the same research cited earlier, drives a Toyota, Honda, or Ford, with a median purchase price around $31,000. They understand something most people never stop to consider. Transportation is a utility, not a status symbol, and treating it as a utility is one of the fastest ways to free up serious money without changing anything about your actual quality of life. Housing works similarly, though it requires more nuance because housing is genuinely necessary in a way a truck isn't. The relevant question isn't, can I afford this? Which almost any mortgage calculator will approve you for at a number well above what's actually wise. The question is whether the home is sized for your life or sized for impressing people who visit it a handful of times a year. Square footage costs money every single month, whether it's being used or not, and none of those costs pause just because the room sits empty most of the year. Here's where this gets genuinely interesting, because looking less wealthy doesn't just save you money in the moment, it compounds into something larger over time. Let's project what this looks like across an entire career. Say someone consistently chooses the more modest, less visible option across transportation and housing throughout a 30-year career, redirecting the combined gap, conservatively $1,000 a month between the two categories, into investments the entire time. At a 7% average return, $1,000 a month for 30 years grows to somewhere in the range of $1.13 million. That's not from a high income or an unusual investment strategy. That's from two ordinary decisions repeated monthly for 3 decades, never touched, never interrupted by lifestyle upgrades along the way. This is why the plumber with the 10-year-old truck can end up dramatically further ahead than the doctor with the leased BMW, despite earning a fraction of her income. It was never about the income. It was about which one of them was quietly redirecting the gap between what they earned and what they could have spent on appearances into something that compounds, and which one of them was spending that entire gap on being seen a certain way. There's also a form of freedom in this worth naming. Someone who has deliberately opted out of the appearance race stops needing to keep pace with whatever the people around them are buying. There's no treadmill to stay on because they were never running on it. This is a quieter, less discussed benefit of this approach, but for many people who actually live this way, it matters just as much as the financial upside. Let's talk about how to actually put this into practice, because understanding the research doesn't help unless it changes a decision. This week, look at your last major purchase and ask yourself honestly whether it was primarily about function or primarily about how it would be seen. This isn't about guilt. It's about starting to notice the pattern, because most people have never once asked themselves this question about anything they've bought. This month, pick the single largest visible expense in your life right now. Most often, this is a car payment or a housing cost that's larger than necessary. And calculate what the gap actually is between what you're spending and what a more modest, equally functional version would cost. Don't act on it yet, just find the number. This quarter, redirect that gap, or even half of it, into an account you don't check daily, ideally something invested for growth. This is the step that actually converts the insight into compounding, rather than just an interesting fact you agreed with and then forgot. Going forward, whenever a new purchase decision comes up in a visible category, run it through the same simple filter. Is this for me? Or is this for an audience that's barely paying attention in the first place? You don't need a perfect answer every time. You just need to start asking the question, because almost nobody currently does. One day, you'll walk through a parking lot and see two people. One looks wealthy, one actually is. The difference won't be income. It won't even be visible at all. It'll be thousands of invisible decisions made quietly over decades that nobody, including the person standing right next to them, ever noticed.